ultimately it'll end up on YouTube. Okay, good. All right, so let's go ahead and with all that, and unless I forgot, miscalculated, we were on module 3, right? We had gone through the revenue, the expenditure cycle last time, and now we're going to go ahead and jump ourselves into the next cycle, which is the cash cycle. And what we've done here, if you didn't notice, is we've transitioned from talking about the income statement to now talking about the balance sheet, obviously, as we turn over to cash. We will come back to the income statement when we talk about payroll, but we are going to be somewhat balance sheet centric now as we continue through the cycles. Now, remember, guys, even though we're sort of breaking up the financial statements here and going line item by line item in many cases, and you start to get the sense that we're asking you to memorize audit procedures and internal controls and whatnot per cycle, keep in the back of your mind, and the book does a pretty good job of calling out in many cases what assertions we're worrying about. Remember, you've got to be comfortable with procedures that line up well with assertions, internal control procedures, and then the auditor's substantive procedures that line up well with the assertions. That's the logic that I want you to continue to think about and continue to develop as you head into your exam, okay? Now, as I had mentioned last time, not all cycles are created equally, okay? Some cycles are heavier than others. Revenue is heavy, expenditure is heavy, and I'm continuing now to remind you that the cash cycle is heavy. Now, one of the things that we get into right away is we start thinking about fraud as it relates to the cash cycle. Well, why are we all of a sudden calling out fraud when we didn't really necessarily talk about it for, well, we did talk about it for revenue, but we didn't get too much into expenses. But when we start getting into the cash cycle, we start out talking about fraud because what? Because fraud, cash is subject to fraud, because what happens if somebody figures out a way to get the cash out of the company somehow? Well, it's already cash and it's easily, obviously fungible, right? So, sorry, let me switch my location for my mice here. I keep reaching for the wrong mouse, okay? So what happens? The two cash fraud schemes that we want to be aware of for our exam are lapping and kiting, okay? And, you know, we're not trying to give you any ideas here, okay? What we're trying to do is, as an auditor, how would you potentially, well, as the company, how would the company prevent or detect fraud? Because we're interested in the company's internal controls. And then as an auditor, how might we detect fraud, okay? So we come over and we talk about lapping, we talk about kiting. Let's go ahead and talk about lapping first, okay? And basically what happens with lapping, the employee will get a cash receipt from a customer and they'll steal the cash receipt. Now, what happens? The customer is going to complain if we don't update their receivable account and whatnot. And so the employee is going to wait for a subsequent receipt to come in. And when that subsequent receipt comes in, they'll do what? They'll cover their original stealing of that cash with that subsequent receipt. Now, the idea often with the lapper, okay, that's the person doing this scheme, they're thinking, well, I'm going to take this money that I stole and I'm going to go to Vegas and I'm going to double my money and I'll put the money back and I'm just going to cover this. And of course, what happens? They don't win in Vegas, like most people don't. And eventually there's going to be a cash shortage, okay? So the company is interested in putting in safeguards against lapping. And as an auditor, we would be interested in some of these safeguards. Now, let's just start with the best method that they talk about here. One of the best systems to guard against lapping is the lockbox system, okay? So flashcard that, but in a lockbox system, basically, and I think we've mentioned this before, the customers, the client's customers send any payments in on their receivables or whatever, they send that in directly to the bank so that the employee never gets a chance, has never been tempted doesn't even have to deal with the temptation to steal that money. That's one of the best ways to guard against lapping. Now, another potential internal control that could be put in place by the client, okay, and this is an internal control, okay, and you can flashcard this internal control as well. In fact, you could put both of those on the same flashcard. What are some good internal controls? Lockbox is probably the best. Another one is to have a separate third party, like well, not a third party, but somebody that's not involved in the cash receipts and accounting process, like the internal auditors, and have the internal auditors compare the cash receipts with the funds actually deposited. Okay. Now, it's important to note that the auditor could also do this procedure to do what? To detect lapping. So even though we're talking about in the context of control, the auditor could also go ahead and do this as a way to detect lapping, okay? Also comparing details of bank deposits and details with remittance advice. Remittance advice is when the client's customer comes in, they pay and they get what? They get a receipt. That's what a remittance advice is. So there should be what? A reconciliation between the remittance advice and the actual bank deposits that went in. Okay, so go ahead and maybe flashcard all of these on the same flashcard, I guess, as good procedures against lapping, good internal controls against lapping. Okay, you can put them all on one card, really. But then at the same point, realize that the auditor could do what? The auditor can't do the lockbox, but they can observe to see that the lockbox is being used. And then the auditor could also do what? Do these procedures as a way of detecting the lapping. Okay. Okay, that's lapping. Now, what happens? Kiting. What goes on with kiting? And kiting occurs when a check drawn on one bank is deposited in another bank and no record is made of the disbursement in the bank from the first bank until after year end. Now, this allows what? This allows the entity to go ahead and count the cash simultaneously in two different bank accounts, thus padding the cash, maybe hiding some sort of theft or something like that, okay? Because we record the receipt in one bank, but not the disbursement in the dispersing bank, okay? Now, what happens? To ensure that kiting has not occurred, and you can never ensure, so they shouldn't use that word too, but basically to detect if there has been kiting, because we can't insure anything. That the word insure makes it sound like we're giving 100% assurance, which we are not. Okay, but to ensure that kiting has not occurred, evidence should exist that all deposits in transit listed on the bank reconciliation of year end have cleared the next period. Okay, and they say that this is information can be confirmed by using a bank cutoff statement. Okay, so what I want you to do is put here that with the bank's cutoff statement, make sure nothing is received before it is dispersed. Money has to be dispersed from bank one before it can be received by bank two. And if you see a receipt coming before the disbursement being listed, then something is wrong. Okay, that's what we're trying to do with that bank cutoff statement. Now, they tell us the bank cutoff statement and then they don't show it to us or discuss it here. And so I want you to go ahead and put C page 19 here, okay? And what I want to do is I just want to jump over to page 19. We'll come back to some of this in a second, okay? But let's go ahead and let's take a look at this idea of the bank reconciliation, okay? And the bank reconciliation is going to do what? It's basically going to have balance per books and get to balance per bank. And there'll be what? There'll be outstanding checks and deposits in transit that will allow us to do that reconciliation. I think you all know what a bank reconciliation is, okay? Now, that's what we're doing with the reconciliation, but what we're looking for here is what is the bank cutoff statement, okay? And what we'll do is we'll agree deposits in transit and outstanding checks to the bank cutoff statement. The bank cutoff statement, you order that directly from the bank, guys. And what it does is it shows items that cleared the bank 10 to 15 days after the year end. And it is what? External evidence, right? Because we are worried about theft of cash here. It gives us external evidence that shows that those items that were listed as outstanding checks, those items that were listed on the bank reconciliation as in transit, that they actually clear. Okay. Okay, good. Now go ahead and flashcard that that's what a bank cutoff statement does. Okay. And what the auditor does with that bank cutoff statement, okay, they sit there. Now go back to where we were, and the auditor prepares. Okay, this is the auditor now prepares a bank transfer schedule. And for you can just put by auditor, because sometimes I think we don't do, Becker doesn't do the best job telling you who's doing what. Okay, this is by the auditor, and any bank transfers that occur near year end, the disbursement date on the check and in the ledger for the disbursing account should precede the receipt date. Okay, it should go out before it comes in. That's my point here. Okay, so I want you to flashcard that, and then I want you to put C, and we're going to look at multiple choice question. Okay, multiple choice questions 0, 5. Oh, I think they took out the zeros now, so it'll be 5, 4, 7, 2. Okay, multiple choice question 5, 4, 7, 2. Here we go, guys. Nice knowing you, because I have a feeling that when I take the computer out of tablet mode, the camera's going to click off and I can't get it back. Okay, but that's okay. You don't need to see me, right? So, so see you later. Okay, but let's go ahead. Let's hope it doesn't happen, but I doubt it. Okay, all right, good. So far it's still there, but let's go ahead and let's take a look at, and I need to get into my software, which is here. Okay, and let me get myself, well, I don't have to, I can just do it here. So I'm looking for question. I said 5, 4, 7, 2. Okay. And they say bank transfer schedule below. Okay. The auditor prepares a bank transfer schedule looking for kiting, right? And what the auditor is looking for is there a situation here where I can see that money was recorded as being received before it was dispersed? And when I look at this, I see that, okay, this one has a disbursement date and a receipt date that's the same day. So that was not recorded as being received before it was dispersed in the client's books. And I just focus on the books here. Here I look and I have what? I have 12/31, the disbursement date from the client's books. It was received the same day, nothing weird there. This is dispersed and received the same day, happened in the same year. This one gets dispersed in year 2 and arrives in year 1. Now, unless the client has a time machine, I don't think that can happen. How can you disperse the money before it is received? Okay, so that's why D is the correct answer there. Okay, the auditor would prepare this bank transfer schedule, and this would be part of the logic that the auditor is going through to help them detect some kiting. Okay. Okay, good. Now you come over, and I think we put down the main things we wanted to flashcard there. Okay, and let's go ahead and keep our fingers crossed. I'm going to put myself back in tablet mode and hope that the camera doesn't shut off. What do you know? Okay, thank God for small miracles, right? Okay, and then we come over and we go over to the next page. Okay, now another key procedure over cash, okay, is this bank confirmation. Okay, so what'll happen? The auditor will ask the bank to confirm the cash balance. So we're ordering this, we're getting information directly from the client's bank here. So this bank confirmation is coming directly from the bank cutoff statement is coming directly from the bank, okay? And they tell us here that the standard bank confirmation, this is an AICPA document, the standard bank confirmation, should be sent to all banks that the client has done business with, regardless of whether there is a year-end balance to confirm, okay? So flashcard that, okay? And they tell us that this is done because the bank confirmation, in addition to verifying year-end cash balance, also provides evidence about actual loans, contingent liabilities, all kinds of additional information is going to be asked here, okay? In other words, what? We are able to do a completeness test for liabilities by doing what? By sending a bank confirmation out, even if it says, hey, the account balance is 0 or we close that account or whatever, you may discover what? You may discover a hidden loan that way, okay? So you take a look at that standard bank confirmation. Of course, you'd want the balance. You'd want the interest rate, because that interest rate will help us to recalculate interest revenue at some point in time. But then notice it says what? Hey, we borrowed some money and here's the balance. So you're actually searching for an unrecorded liability there, right? That's really a completeness test. Okay. All right, good. So that's the bank confirmation. And then, as we've already mentioned, the other key piece of evidence will be the bank reconciliation. Now that's prepared by the client, right? But then we get some external evidence about some of the things that are listed there on that bank confirmation that the client prepared at the end of the year, about outstanding checks and about deposits in transit, and it allows us to do the bank transfer schedule that'll help us with the kiting exercise. Okay. All right, good. Now coming over and, let's take a look at a couple of procedures here. And for the completeness, we're going to do what? What are we going to start with for completeness? What do we start with for any completeness test? Any completeness?
You start with the source documents.
Good. Start with the source and take it back to what? Accounting records?
Yeah, financial statements, accounting records.
Good. Okay. That says records. Okay, good. We're going to end up with the accounting, I guess I could say end. I guess it's source docs. Okay, let's do it that way. Okay, good. Start with the source docs, take it back to the accounting records. So let's take a look. So they tell us that for cash receipts, the auditor should take a sample of remittance advices. Remember, when the person gives the money to us, they get a remittance advice back, don't they? Okay, and we have a copy of those remittance advices that we handed to that the client handed to their customers when they received that cash. Okay, it's basically a receipt. Okay, and so what happens? And we take that back to the receipts journal. Okay, good. So we are doing what? We're just taking the records and we're taking the documents and we're taking them back to the accounting records. Okay, for disbursements, we should do what? We should take a sample of checks, that's the source document, and take it back to the disbursements journal. Okay, good. So flashcard those two procedures for completeness, one for disbursements, one for receipts. Okay, now let's jump down to, not all assertions are created equal per account, guys. For example, valuation of cash. Who cares? I mean, whatever they say the amount of cash is, that's what it's valued at, right? Unless they had some sort of foreign currency, I guess. But anyway, let's just take a look at for the existence assertion, okay, and for cash receipts, okay. The auditor should take a sample of entries in the cash receipts journal to the remittance advices, deposit slips, and it should hit the bank statement, right? Although the bank statement is more of a document, but we're basically doing what? Yeah, we're going from that. It's also a document. So we're going for existence, and I should have asked you this before, but we start with the accounting records. And we go back to what? To source documents. We end, if you will, at source documents. Okay, good. And that's what we're doing there. And that's for cash receipts, right? For our cash disbursements now, okay, the auditor would do what? The auditor would take a sample of entries from the cash disbursements journal and go back to the canceled checks, etc. Right? So again, we're starting with the accounting records and we're taking them back to the source documents. Okay, good. Flashcard those two just because cash is heavy. And I could see the examiners expecting how to audit the very important assertions of existence and completeness there. Okay. Now we get into presentation and disclosure here. And look, most entities, most audit organizations are going to have a disclosure checklist. And that disclosure checklist is essentially going to go down the different accounts and see what sort of disclosures you should be looking for. Okay, so this is not exactly, rocket science. You're basically looking to see if they have any restrictions on cash, what are their policies for defining cash and cash equivalents. For example, cash equivalent is a highly liquid item like a treasury bill, certificate of deposit. That's an original maturity to the purchaser of 90 days or less. That's per GAAP. That's something that we would expect in the significant accounting policies probably to be disclosed in the financial statements. I'm not going to ask you to flashcard that because you see a question on that where we're asking you about disclosure stuff, guys, just flashcard it, whatever that question teaches you. Just make a flashcard out of that. This is, sort of small point value type stuff that you just got to kind of remember on the day of the exam. You might get one or two questions that constitute some of this stuff. Okay, good. So let's come over and let's go ahead and take a look at a multiple choice question, our first multiple choice question for tonight. Okay, so I'm going to go ahead and put the poll up. And I'll give you a couple minutes to look at that. Okay, guys, it's a little shorter than the 2 minutes by a couple seconds, but it looks like everyone's had a chance to try this one, and good. I think this is pretty good results for this question. This is a tough question. Okay, so we got 80%, got the correct answer A. Pretty tough question, but let's go ahead and let's look at this one because we did have, I think, a vote for every single one of the choices here. So let's take a look, and we say on receiving a cutoff statement, an auditor most likely would trace, and again, I don't like getting locked into trace versus vouch. Just don't worry. Worry about what it is that you're trying to accomplish by this, okay? And what we're trying to see is, hey, is the cash correctly stated here, right? Okay, so don't worry about trace and whatnot, but they come over and they start to look, and let's just look at the things that saying the auditor would most likely do, okay? And you start to look at this, and it says D, and we start at the bottom, deposits recorded in the cash receipts journal after year end to the cutoff statement. Who cares? If they made a deposit after the year end, I don't care. Yeah, and it should be listed. Maybe it would have been listed on the bank cutoff statement, but who cares? That's a deposit was made after year end. That's not going to be included in the what? In the year-end cash balance. So I guess the auditor might do that if they were bored looking for something to do. Okay, there's really no audit evidence to support anything existence completeness for this current year, for this year that we're auditing, right? Okay, now we come over and we look at item C, and item C says you would look at checks dated after year end listed in the cutoff statement to the year end outstanding checklist. Well, checks dated after year end are not going to be listed as outstanding checks on the reconciliation because they weren't outstanding at the end of the year. So C is wrong. Now, we had quite a few folks, and I should have not, I closed the results a little too quickly there, but I think we had a pretty good split between A and B. Okay, and that's actually a good sign, even though A is the right answer, because B is very, to me, unfair for them to even put B here. They say deposits in transit. When I say they, I think this was an exam question. Deposits in transit listed on the bank cutoff statement to the year-end bank reconciliation. Well, the problem here with this one, which makes A a better choice, is the bank cutoff statement doesn't list those as deposits in transit. They simply list them as what? Deposits that came in after the year end in that 10 to 15 day period. So they won't call them out as deposits in transit, even though the year end bank reconciliation may have called them deposits in transit. They are not listed as such on the bank cutoff statement. Now, you look at that, and I'm telling you that's the wrong answer, but if you look between A and B and then said most likely, well, A is the best worded answer, and that it says what? Prior year checks listed on the cutoff statement. It's not calling them outstanding checks. It's simply saying this was a check that had a date from what? From the prior year, the year that we are auditing, right? In the cutoff statement to year-end outstanding checks. Yeah, that's what we want to see. Okay, the bank cutoff statement is 10 to 15 days after year-end, so it would be a prior year check before the year had ended or by the year end of the previous year, and we want to see that listed as an outstanding check on the checklist. Question. Okay, so good work on that question. I think most of us got it right, but yeah, a little tricky, a little bit tricky there, definitely. Tricky question. Okay. When I say tricky, between A and B, C and D are nonsense. Okay. Okay, good. Let's take a look now, continuing our journey here through the balance sheet. We talked about cash. Let's look at another heavy cycle that's listed for the balance sheet now. Put my H down here. Orange on reds, good. And that's going to be what? That's going to be the inventory account. Okay, now again, guys, it is important to think about how will you audit the assertions. Okay, and when you audit assertions for inventory and for fixed assets, it is easy to picture how you're going to get what, how you're going to get satisfaction, how you're going to get some evidence in support of the assertions, because it's a physical thing that we're talking about. But the logic is no different than if we're talking about something that's more, esoteric, such as investments or something like that. Okay, but the logic is the same. Okay, so let's just go ahead and they talk about what duties should be separated here. And we know that we separate what? We separate authorization, record keeping, and what? Custody, right? Okay, so as we go through, and we probably have some feeling for this already because we already talked about the purchasing cycle, right? Which is part of what inventory. I mean, we purchase more than inventory, but we also do purchase inventory. So we could sort of remember from our discussion of the expenditure cycle here to help us to remember which of these is authorization, record keeping, custody. Purchasing is what? Authorization, right? The purchasing department will have to order those goods. Then what? Receiving is custody. Okay. The what? The warehouse is custody. Okay. When we're selling our stuff, our shipping department is also going to be what? Also going to be custody. Okay. Now we come down and we talk about auditing the inventory balance and flashcard. We need to observe the client's taking of the ending inventory. Unless inventory is immaterial or we are able to perform some alternative procedure, we must observe the client taking the ending inventory. Now, I was put on an assignment at one point in time at the GAO, and frankly, they put me on that assignment so I could sign off on experience of observing inventory when I'm attaining my CPA, getting the experience for my CPA. So they let me get on that assignment. And so you go to Washington and you get put on the Senate restaurant audit. Okay, what they do is they, hand you a parka and say, okay, go with this group of employees to freezer number 72. And observe them counting the inventory. So you put on this parka and I go and I observe these guys doing the inventory. And what they're doing is they're taking the inventory control sheet that they have and they're saying, okay, how many chickens in this freezer? And then they go and find the chickens and they count them. And then they say, how many pork butts in this freezer? And they go and they find the pork butts. How many filet mignon? They go and they count those filet mignon that are sitting in that freezer, okay? Now, is that proper inventory taking technique? What they just did? That's a question. Should have I been happy with that?
Didn't sound too good.
But you're watching them, right? You're in there with them.
I'm watching them because we're doing this before the actual count will happen, Donald. So we're doing this like the day before the actual count. Okay. And I'm watching them to see what they're doing. And am I happy if they're sitting here and they're reading off the list and going and finding the things and recording the inventory that way? I was not. That is not proper inventory taking technique, okay? When you take inventory, you need to do what? You need to go ceiling to floor, wall to wall, everything that's in there and record it properly on the inventory sheet, okay? You don't read off a list and go find this stuff. What assertion is being harmed there? If you have a list of things and then you go and find the stuff, what assertion is being thrown out the window? It's being not covered very well by that.
Completeness.
Good. Completeness is not being covered because what about the box of T-bone steaks over there that wasn't listed here that never got counted. Okay, not only is the inventory sheet now not going to be complete, but probably employees are going to steal those filet mignon because they know that they're there. They know what's in the freezer. They know what's there, and they know that it's not being counted. So no one's going to miss it if it's gone. Okay, so I go back and I told the guy this, guys, are you sure you're supposed to be counting the inventory that way? And I'm not shaking because I'm scared. I'm shaking because I want to get the hell out of this freezer. Okay, but basically I go back and I write up, hey, this is what I observed. This is not proper inventory technique. And they go ahead and they pull the staff together and they say, GAO observed that you weren't doing this correctly. Remember, the correct procedure is sealing the floor wall to wall. Then you go back out with them on the actual day and you see that they're counting the inventory correctly. Okay, and you got a good feel for that inventory count. That's what you're doing. Okay, so let's just flashcard here that the objective of this is evaluating management's instructions and procedures, observing the performance of those procedures, inspecting the inventory at that point in time for its condition, right? If you're there and you look and you see that they got a bunch of damaged stuff that they're counting up, well, that's going to be a problem, right? So you want to see that. And then at some point, you will perform test counts. Now, that doesn't mean that you recount the whole inventory. What you do is you select a sample of, say, freezer X or pile Y or, shelf 22, whatever. You pick a sample of items and you recount to see if you come up with the same number that they do. Okay, that's the purpose. You're not the one that's counting the inventory, they are, but you will perform some test counts. Okay. Now, notice here we say that an auditor who is not present to observe the physical inventory must use alternative procedures, and this is acceptable when it is impractical or impossible to observe the inventory, or if it's not material, then you really don't care that much. I mean, if something's not material, I really don't care. Okay, but an alternative procedure might be, let's say I'm not there at December 31st. Let's say I wasn't engaged as an auditor at December 31st to do that work. Well, what happens? If I come in, say, January, maybe I can have them recount the inventory in January and we could back through a set of purchases and sales to get to what the inventory should be. And if that matches the accounting records, then I might be satisfied with that. Okay. But, that would be an alternative procedure. Okay, most cases, we expect you to go ahead and observe that, looking for those different things that we're talking about. Okay, now we come over and they tell us that if the company, counts their inventory throughout the year, then you could go ahead and observe the inventory before year end. Okay. Now, if inventory is done at a date other than the year end, the auditor should obtain evidence about whether changes in the inventory between the count date and the financial statements are properly recorded. So what they're really describing to you here is what? Apparently, we must have had a lower risk of material misstatement. So we did our observation at an interim date, didn't we? Okay, that can happen, but you still have to do what? You still have to roll forward. Okay, we've mentioned that term before, to make sure that things still look pretty good towards the year end. So you might take a small sample of items to see if they were recorded correctly. Maybe you look at some recent purchases of inventory and you look to see that those are still there or actually arrived or whatever, right? Okay. Okay, good. Note again, which we know this already about any account, if you have an assessment or risk of material misstatement at high, then you, of course, do your testing at year end. And that's the case for any account, right? Okay. Then you come over and the auditor should observe the physical inventory count held off-site in public warehouses or out on consignment. So you would have to send a confirmation if there's an off-site warehouse saying, hey, do you hold this much inventory in the client's name? If it's on consignment at another entity, right? They're holding their goods at another store. hoping that somebody will buy it from that store, then you need to confirm with whoever that store is or go over there and look at it, right? And count it somehow, assuming again, it's material. Also, flashcard, observe inventory at, I'll just write the word at multiple sites. Simultaneously. Flashcard that, and that might be in the book somewhere. I don't know where it is, if it is there, but I'm just going to have you write it in flashcard here. Okay, observe the inventory at multiple sites simultaneously. So if you have a client who has a warehouse in San Francisco and one in San Jose, and they tell you, oh, well, we're going to count the inventory in San Francisco on Wednesday, and we'll count the inventory in San Jose on Friday. Well, that sound you hear is the trucks going down Highway 101, and you're going to count the same inventory twice, right? So you want that to happen simultaneously. Okay. Now, they remind you here what I've already articulated to you, okay, which is, oops, I'm gonna have to cross it out. We already mentioned it though, which is, you know, the CPA does not count the inventory. They observe the client taking the inventory, and then they may do some test counts, okay? Now, notice we have what? We have the company inventory report, okay? So that's sort of that piece of paper that I was holding up. Now, of course, that inventory report will feed up into the financial statements, right? Okay, so in effect, that is not any kind of supporting document. That's a listing of the inventory. So our work is going to make sure that first, what the amount that they're showing for inventory ties to the inventory report. Otherwise, we're going to tell them, you got a problem here that's not my problem. Okay, so we're going to sit here and make sure now that that inventory report is correct. And then, of course, it should tie up to what's in the financial statements. Okay, so what happens? I'm going to go ahead. I observed the client taking the inventory. I made a few test counts. Okay. And for the completeness assertion, I'll go from my test counts to see if those things were reported correctly. For the existence assertion, I'll pick a few items from the inventory report, go and do some test counts to see if that ties up, right? Okay. Now, they talk about the pre-numbered inventory tags here. Okay, so what happens? The client will count the inventory, as will the auditor with the test counts, but the client counts the inventory items. And there's a little tag here that says, okay, there are 53 of these things. Okay, so the auditor will take that tag. There's supposed to be 53 of these things, and they'll do what? They'll go back to see if it's reported in the inventory report correctly. What assertion is that?
Completeness.
Good, that's completeness. Excellent, Donald. I'm going and I'm saying, okay, it's there. Here it is. It got reported. If it's not there, I discovered something that wasn't complete. Good, and then I'll do what? I'll find something on the inventory listing, and then I'll go over here and I'll say, oh, okay, here's the tag for this thing. And it says there's 23 of them, whatever, right? And I won't necessarily have to redo a test count of that because I already did some test counts procedures earlier, didn't I? Okay, and so I'll trust what's on that tag. But again, that's going to be what? Existence, because I went from the sheet to the actual physical item. And you know, I don't understand why they have to have these little laptops down here. We're going laptop to laptop. They should be putting boxes over here of stuff, right? I mean, it's the actual inventory. I don't know why Becker chose to show a little laptop there for both of these. Now, I heard from a colleague, and to be honest with you guys, there's a bunch of old guys sitting around shaking our heads, wondering what's happened to the world. One of the guys, he's a partner at one of the big firms, and he's like sitting there laughing while we're having lunch. He says, you know how we do inventory observation now? And I'm like, no. And he's like, they go and they hold their camera up to the thing, and that's how we look at it. And it's like, okay, the world has changed because in my day, you had to go and put a parka on, but stuff is not nearly as, you know. And I used to walk to school in the snow up to here, even though I lived in Hayward. Okay. All right. So let's go ahead and let's take a look at a couple of things here. We've already seen this in the graphic, but let's go ahead and see it now in the pros here in the text. And they tell us what we're going to select from a sample of pre-numbered inventory tags and take it back to the physical inventory report. And then we're going to also do what? Take some test counts and take that back to the inventory report, right? For completeness, those two things that we saw graphically up there, okay, the test count and the inventory tags. And then for the existence assertion, let's just jump down to that. We'll come back to a couple of these other things, but for the existence assertion, let's just jump to that. And for the existence assertion, the auditor should test existence items on the client inventory sheet by going to a sample of items, and then from the inventory report sheet, okay, to the corresponding pre-numbered tags. And the auditor should verify the existence of a sample of items in the physical inventory report by locating and performing test counts. Again, we saw that in the graphic, but just go ahead and you can flashcard those two steps there. Okay. Now, when you come up back to a couple things, rights and obligations. Okay. Let's take a look at rights and obligations. Oh, okay. I guess they move rights and obligations down here. That's great. Rights and obligations. Let's look at that. And the auditor should confirm that any inventory held off site is properly accounted for. In addition, inventory in transit at year end should be properly accounted for based on the shipping terms, free on board shipping point, free on board destination, etc. Right? Free on board shipping point should be included in the client's inventory destination, not until it arrives, right? Okay, we know that. And then if there's inventory that's consignment, that needs to be included. Okay, so make sure you are comfortable with what it is that we need to do about items in transit and things in consignment. Okay. Okay, good. And then when we get to disclosures, one of the big disclosures for inventory would be if something has been pledged as collateral, okay, for loan agreements or whatever, that obviously what needs to be disclosed. If there's warranties on certain things, that's probably part of our rights and obligations as well. Okay. Okay, good. Now you come over and you take a look at this question. Go ahead and put up my poll. What assertion, guys?
Existence.
Good. All inventory items listed are valid is a surrogate for saying what? The auditor is testing the existence assertion, right? Okay, good with that. Proceed. Okay, looks like we've had a good amount of time to work this question. Most folks have had a chance to try it about 2 minutes now. And okay, we got a 71%. Now, we're talking about what? We're talking about, they got this correct. Okay, we're talking about the existence assertion. Okay, but let's go ahead and let's just go through these choices. Okay, we're talking about existence. It means something's recorded in the financial statements. We want to see if it's really there. Now, the first one, choice A, which some of us consider, says that, hopefully you can hear me, that the auditor is over here. Okay, you can see me over here. Okay, I'm taking the inventory tag that I noted during the observation. I see, okay, printer, big old printer, okay? And I'm taking this and I'm taking the tag and I'm going back to the listing to see if it's listed. How is that helping me with existence? It is not. I see the thing, I know it exists. I just want to make sure that they recorded it, don't I? Hello?
That would test
Yes.
completeness.
That would test completeness, not existence. I know it exists. Here it is. I want to see if it was recorded. That's completeness, right? Okay, so A is wrong. Okay, then they say what? Inventory tags, note of the auditor's observation to items listed in receiving reports. Well, you know, I guess the auditor would do that if they were bored. I mean, if the thing is here, then it obviously was received. Maybe I'm just wanting to see if they list it as received, but so what? And it obviously doesn't help me with what? Existence. Okay, so that's what, maybe a completeness test, but I would think that you'd want to see the receiving report and then you would take that to the inventory listing, and maybe you're looking for the receiving report to see if they are what, properly counting up the inventory and whatnot or something at that point. Okay, but again, it's all about completeness. Now, items listed in the inventory listing, and I don't know if you guys can see this. I don't know why this state franchise tax board is fining me for late payment. I paid my taxes on time. So this is sitting on my desk and I got to call them and say, what the hell are you doing to me? Anyway, we have this listing is what this thing really is. Pretend it's the inventory listing. I'm looking here and okay, there's supposed to be a bookcase over here full of books. And I go and I find the thing. Here it is, okay? So that is what? That is existence because it was listed and then I went over there and found it, didn't I? It's there, okay? And then D, items listed in receiving report and vendors invoice. Again, A, B, and C are maybe good procedures for the wrong assertion. Okay, that's why it really, I get kind of irritated with Becker when they have that 5 carat wars and they start listing off a bunch of procedures. I think they're doing you a disservice with that because it does you no good to just have a bunch of procedures. It could cause more harm than good, to be honest with you, because you got a bunch of procedures rattling around in your head. Meanwhile, they list procedures, but it's with the wrong assertion. So you always have to do what? You have to sit there and you have to do what? You have to know how to audit the assertion and don't memorize a word like trace and vouch, because if you memorize the word trace, you were hopelessly lost in this question because you thinking they meant completeness. They did not, they meant existence, which Becker acts like that's always stated as vouch. And here's a question where they did not use vouch for existence. Okay. Okay, good. And let's come over and let's take a look at our next cycle here, which is the investment cycle, our next module. Now, the investment cycle is fairly light. Okay, they don't go too far off in the investment cycle. And one of the first things we're going to see is that the authorization for making investments comes at a high level. Okay, this is board of directors level authorization. Okay, for purchasing investments, for selling investments. I was on an assignment looking at the House of Representatives Child Care Center, and they had some funding that they had received, I think some donations, and they put them into a T-bill. And then they cashed the T-bill to operate. Okay, and when I called the board of directors to say, well, they cashed in the T-bill, was this authorized? Because I could see no record of an authorization in the board minutes or anything. They said, what T-bill? Okay, we have a problem here. You know, they have an internal control issue. I mean, it was okay for them to, it wasn't like any kind of fraud or anything. They did, I could see that they used in operations. In fact, the director, the executive director of the Child Care Center, because when I went through, they ended up having to report a loss for the period, said she was going to resign, and she blamed it on the way that I accounted for things. I told her, well, you cashed in a T-bill to operate. What did you think was going to happen? So, yeah, but anyway, she didn't resign. But that should be authorized, right, by the boards of directors. Okay. Now, custody for investments, and this is a little old hat here, guys, in that they're talking about what there should be joint control of two company officials, and investments should be kept in a safe deposit box. Yeah, if it's 1968. I mean, these days, what most investments exist in book entry form. You know, there's just some account somewhere that says you hold so many shares of this stock, whatever. And so we're going to see that the big step for confirmation for existence is going to be confirmation. Now, having said that, if you have a client that maybe has some foreign investments, some foreign entities still will issue a stock certificate or something. And so I guess it would be relevant there. Okay. And so if they say if it is held by the company, right, there should be a separate separation between the custody of the investment and then the record keeping, right, which is what we say here. So authorization, record keeping, custody. Okay. Now we come over and we say that there should be internal controls over fair value measurement. Now, fair value measurement for investments can be as simple as what is the stock's listed market price at the end of the day? And you pick up the Wall Street Journal or the Yahoo Investments or something to see what that is. But if it's a stock that's not listed, then you may need to do what? You may need to get a little more sophisticated about that, right? And then it's important that that we make sure that the classification is correct. Okay, if it's a stock trading available for sale, if it's a bond or debts, investment trading available held to maturity. Okay, so we want to make sure that classification is correct. And then controls surrounding fair value estimates, whether inside the company or outside the company, should we use a third party, also must be understood. And why don't you go ahead and flashcard here. Separate fair value determination from investment selection. Okay, flashcard that. What does that mean? So we have some guru who sits here and says, okay, these are the investments that we should invest in because these are going to be good investments. And they go ahead and they make investments in a bunch of stuff in which they're not listed, right? There's some sort of stock that's not listed. Do we want that person to also say, this is the fair value of these? No, of course that person is going to be interested in what? In inflating that fair value so that they look like a genius. So we want what? We want maybe either a third party to do that or somebody else in the company to say, okay, this is the correct fair value, right? Okay. Okay, good. So you come over and you take a look at the next area here, and let's see what procedures now for evidence. Okay, so this is getting more into our substantive procedure. Okay, so we come over now, we've understood something about the separation of duty. And now we're talking about substantive tests. Okay, so substantive tests of detailed related investment cycle generally focus on the ending balance. Okay, so let's just go ahead and flashcard that. Okay, you take an ending balance approach because what? They're probably, unless you're auditing, investment house or something, you're auditing a manufacturer or service entity, there's probably not a lot of investments that are purchased and sold over the course of the year, right? Okay, so you would basically sit there and look at the ending balance. Okay, now again, looking for our assertions here now, you can see that we're going to be examining transactions for a few days after year end. Now, when they say transactions for a few days after year end, what transactions? Okay, that's a little vague. Okay, so I think one of the transactions you're looking at is what? Cash disbursements. Okay, you're looking for a cash disbursement after year end. So what happens? You see this big cash disbursement in 20, say you're auditing, 20, what year is this? You're auditing 2022. I almost said 2013. I used to get mad at my dad and say, oh yeah, it's 1923. I mean, 1910. Dad, do you mean 2010? You weren't born in 1910. Okay, so now I'm doing it. So it's what? It's 2022 statements. So we'll look in 2023's cash disbursements and we see what? We see this $10 million disbursement. Well, we say, what was this for? And they say, well, we bought a security. Well, when were you committed to buy that security? Because sometimes you can commit to buy the security, you have what? Control that security, but you don't get around to paying for it until what? The disbursement for that until after year end. Well, that should be recorded as investment what? At the year end date, not after year end. Okay. Okay, so you're probably looking at for some cash disbursements for that after year end. So go ahead and flashcard that. Okay. Now they tell us that the auditor should confirm securities held by a third party. Okay, so flashcard that as a good test. You know what? Don't flashcard it here. I'll show you. I want you to flashcard it somewhere else. That's not a good thing to list for completeness, because confirmation is more of a existence step. Okay, so let's just come over and let's look over here and let's take a look at valuation. Okay, and for valuation, obtain evidence corroborating the quoted year-end fair value by comparing it with various published sources, Yahoo Investments, Wall Street Journal, whatever. Okay, and then you come down and they tell us to recalculate or obtain from a third party, such as an independent broker appraiser is not the cat that sold it to you. Don't go to the person that sold it to you and say, hey, what do you think the value of this thing is that you sold me? Because they, again, are going to want to seem like geniuses or whatever. So it's an independent broker or appraiser. That's for what? For investments not listed on stock exchanges, that sort of thing. Okay, so you get some sense as to the valuation that way. If they are holding bonds and they are held to maturity bonds, then what? Then those should be carried at amortized cost. So you're going to have to do what? You're going to have to, oh, I don't have to write it, it's right there. You're going to have to recalculate, right? What is the amortization of the premium, the discount, that sort of thing, okay? And recalculation for valuation allocation is something that we're used to seeing, okay? And then if we have an investment in which we're going to be using the equity method because the entity holds a, more than 20%, up to 50% they would consolidate, okay, but between 20 and 50%, using the equity method, then what we should do is obtain audited that says audited financial statements of investee. Okay, flashcard that. Now we're going to do that because what? We get the audited financial statements of the investee, and it shows that the investee made $1 million and we own 40% of that stock. What should we do? We should debit the investment account for 40,000 and what I say?
40%.
But I forgot what I said. The income.
$1 million.
$1 million. So we should debit the investment for 400,000 and credit our investment earnings for 400,000. And we should look to see that that's what they did, right? But you need the audited financial statements, and that's a pretty good piece of evidence to leverage that procedure off of, because what? It's external third-party verification of the amount, right? Okay, so you'd probably you want to get that. So flashcard that. Okay. Now, come over and let's take a look at for the existence assertion. And again, the reason I didn't, existence gives you, confirmation gives you evidence of completeness, but it's really more of what? An existence test that we're worried about there for an asset. Okay, so just flashcard it here under existence, although it could give you some evidence as to completeness. Okay, good. If securities are on hand, okay, then you want to go ahead and examine those securities, okay, and this is irritating, okay, but I still see questions talking about a securities count and asking the client to sign off that they were returned intact, etc. Okay, so flashcard that's a dopey thing, because again, in most cases, the security, the investment's going to be held in book entry form somewhere. Okay, we don't really have a whole lot of securities anymore. Okay, now come down and the auditor would have the expectation that interest earned on investment in debt securities will agree with the effective interest rate when the security was purchased. Okay, so the auditor may perform analytical procedure to obtain evidence that interest earned does not materially different from the expectation. So what happens if I'm holding a debt security and the debt security is $1 million and the effective interest that says interest rate on that is, say, 4% or whatever, then they should have what? They should have interest income of what? 4%. Help me out, guys. What is that going to be?
40,000.
40,000. Should be about 40,000, right? Now, it doesn't have to be perfect with 40,000. We can have a range. In other words, this is what? This is an analytical procedure, isn't it? Okay, so really we could say recalculate. Now, of course, I first have to be comfortable with what? This number. So I probably would send out the confirmation. Do you hold $1 million bond? Okay, the bond actually exists. The bond investment exists. Look and understand what that effective rate is on that and do some sort of recalculation like this. Okay. Okay, good. And that's an analytical procedure where we're recalculating. So yeah, we can go ahead and flashcard that. And we're auditing related accounts there, interest revenue and the bond holdings. Okay. Then you come over and let's take a look at auditing the investment transactions now. Okay. And they say that independent calculation should be made to determine any gains or losses associated with sales and discount and premium amortization. Okay. In other words, what? Here we are in valuation. What do we typically do with valuation? Recalculate. Right. Okay. So I want you to go ahead and flashcard that. And then if we're talking about dividend income, now dividend income is probably going to be relevant if we're holding a investment at fair value through net income method. Okay, we would take the dividend as a investment income. You can look at services that tell you what the dividends are that were declared per share. You multiply that by the number of shares that are held, which you got from the confirmation, and you've got something that helps you with the investment income. Okay. For understandability and classification, okay, let's just take a look at that. And unrealized gains and losses unavailable for sale need to go where? Need to go to my comprehensive income. If we're talking about a trading security, that should go in the income statement. Right, that's a presentation classification issue. Okay, disclosure. Okay, when we look at disclosure, if there's some sort of situation where we are going to disclose our methods, whether something's a trading security and whatnot, we want to make sure that that's properly disclosed. Okay, good. Come over and let's come down. And let's just take a look at investments where we are basing the value of the investment on the investee's financial results, which is basically the equity method, even though they're not calling it out as such here. But that's really what happens with the equity method. Okay. And so we should what? Obtain the financial statements and the audit report of the investee, which I already have you flashcard that. And if the financial statements are not audited, ask the entity, your client, to get them audited, because that's really probably the best evidence you need for that. We've already kind of mentioned that. Okay. Okay, good. Now, if investment is held at fair value, okay, which we've kind of been alluding to that with many of these investments that we're talking about, we look to the different levels. If it's a level 1, in other words, the stock is listed, that's easy. Just look up the value. Level 2 says, hey, they don't hold that exact investment, but they hold similar investments of similar companies. Can we look to see, you know, that by analogy, that must be what the value of this particular item is. And then if there are no observable inputs, either the same stock or a similar stock, then we might have to start calling in experts that will come in and help out with that. And they would start, you know, telling us, well, okay, if you look at a discounted cash flow basis or something like that, that would be an appropriate value for that investment. Maybe the company hasn't gone public yet, but they're already holding some investments. You might want to bring in a third party that can help you with that. Okay. Okay. Come over and don't forget, at the end of the day, management is responsible for making sure that the investments are properly reported at fair value. Let's go ahead, though, since this is the auditing exam, and understand what the auditor's responsibilities are. And I just want you to flashcard the ones that I'm going to highlight here, guys. Okay, so understand the entities process. Since management's responsible, understand, hey, management, what do you do to come up with these fair values? Okay, Then test fair value measurements, and we'll talk about that here in a couple of seconds, which is essentially going to be recalculate. And then we will ask management, and at the rate we're going tonight, guys, I don't know that we will necessarily get to the management rep letter tonight, but at the end of the audit, we go ahead and we ask management to put down the management representation letter, which is the last piece of audit evidence we get at the end of the engagement. It's dated the same day as the audit report. We ask them to sign off on certain things, and what the CEO, CFO will sign off on is the securities that they've said are trading, available for sale, held to maturity, that they indeed do have the positive intent and ability to hold those to maturity. Well, we can probably audit their ability, but more objectively, but how do you audit intent? You can't read their mind, so you make them put that down in the management rep letter, okay? Flashcard that. And then when they tell us to test the fair value measurement, okay, and coming down, how do you test fair value measurement? And if it's a quoted price, easy enough, okay, just look it up, okay? The flashcard that you would do that to testing the fair value, okay? Verify quoted market prices, look it up. Develop an independent, keep going down here. Again, I just want you to flashcard the ones I'm highlighting. Develop independent fair value estimates for cooperative purposes. Again, if indeed they are not listing the stock, how do they come out with it? Was it a level 2 input? Was it a level 3 input? Do you need to bring in a specialist to help you with that? Whatever, right? And then that's what they say here, consider specialists if you need to help you understand for obviously a stock that's not listed. Okay, so 2 flashcards there, guys, for fair value measurement, which we've kind of been alluding to in the investment discussion. Understand what they do, test the fair value measurement, and that management rep letter, and then is this verified market price is fine. If not, you might have to look for level 2. If not, you might have to develop an independent estimate for something that's using level 3 inputs, frankly, and then you may need to bring in a specialist. Okay, good. Let's go ahead and let's just take a look at this multiple choice question. And then we'll take the break. Okay, guys, we're at about 2 minutes. Looks like everybody's had a chance to try this one. So let's take a look. And okay, good. We had pretty good results here. And I think I sort of had given you a tip on this one, asked you to flashcard that we would want to, oh, no, maybe I strike that part. For one of the choices that one of us took, the two of us took the flashcard that I asked you to make sure they helped you with that. But anyway, let's just look at this question. Okay, so let's see. Which of the following would the auditor least likely? Now, maybe you picked A because you missed the word least, okay? Because what? The auditor likely would want there to be separation between the what? Just looking at wrong answer A here, okay? The auditor would want to see that there's a separation between the person that commits the entity to purchasing an investment and then the fair value. Because if I told you to buy the investment, I want to bring that up, don't I? I'm not going to sit around and I'm not going to be objective. I may have some sort of unconscious bias against trying to bring that up, right? Okay, so no, the auditor would be interested in that, okay? Somebody picked the role of information technology in determining fair value. Are you kidding? I mean, there's all kinds of information technology that can be exercised to determine the fair value of an investment, okay? I don't know if anybody picked this, whether valuation methods used are appropriate relationship to the industry. Yeah, absolutely, okay? And then B is correct. Let's look at that one. The effect on fair value measurement and disclosure of information available subsequent to the audit. How far after the audit do you want to go? 6 months, a year, 2 years out?
Only to the date of the audit report.
Well, no, we would be interested in what? Information available. Oh, I see what you're saying. Yeah, if it was a quoted market price or something at December 31st, I guess we'd be interested in step up to the audit report if there was some sort of subsequent event that needed to be disclosed or something about a particular investment. So yeah, I see why you're saying that. But in terms of what it's measured at that date, that would be information that took us up to the balance sheet day, right? And then we don't have to sit there and say, well, how did it shift after the balance sheet date? That's probably not, unless there was some huge thing like, they got embroiled in a controversy or something like that. And even then, it would still be whatever was quoted at year end, and then we would want something to be disclosed. Okay, but subsequent to the audit means after the date of the audit report, we are under no obligation to work with that. Okay. Okay, good. Come over and we are going to take the break, and then we're going to start talking about, and they call it other transaction cycles, starting with property, plant, and equipment. I'm showing 6:33. So that we don't have to start coming back at weird times here, let's go ahead and just put 6:45. That'll give us a full break, okay? I'll pause the recording. Zoom the recording, and let's go ahead and jump into module 6 now, other transaction cycles. Okay, now I'm not exactly sure why they broke this all into one module, other than their sort of obsession with trying to break things up into bite-sized modules. But property, plant, and equipment, right? Investments we said was medium. Property, plant, investment we said were light. Property, plant, and equipment is going to be medium, but then we're going to go back to a heavier cycle when we get into payroll. So I really can't give you a logic as to how they're breaking these into modules, but I'll continue to call out to you, whether something's heavy or light, et cetera. Okay. Now we come over and we take a look at the separation of duties, as we've been talking about, okay, for all the cycles. And acquisition there needs to be proper authorization. And because we're talking about higher ticket items for property, plant, and equipment, we're probably expecting that should be approved by top management. It maybe even should go up to the level of the boards of directors, okay? And acquisitions of assets over a certain amount should probably be looked at a little bit carefully. You know, why are they getting into such large investments, et cetera, okay? Now, there will be subsidiary records. It will give details as to the location, et cetera, identification number, that sort of thing, depreciation methods. That's obviously what record keeping, and we'd be interested in those things. We should also be interested in physical security over fixed assets. Okay, so you know, you're going to be interested, are they putting those cable locks on their computers, that kind of thing, right? So that's obviously custody. Okay, and then you come over and they tell us that there should be comparison of the serial number to the identification plate to listed in the that's listed in the control account. Now this really, and you can flashcard, okay, should be done by client periodically. So even though that sounded like an audit procedure, and the auditor may do a procedure like that, the client should do that periodically as an internal control. Okay, because if the client sits there and all day, you know, looks at records and says, okay, this is how much of physical asset we have, and they never go out to see if indeed those things are still there, eventually they're going to be stolen, right? So the auditor would have an expectation that for an internal control, that the client does that periodically, okay? And then when we're talking about disposition, there should be there should be proper segregation between the person that is authorizing the disposition of an asset and then the person that actually disposes of it, right? Okay, and so that's a segregation of duty. Why don't you go ahead and flashcard that for our disposition? So we're separating the authorization for the disposition from the actual custody or actual responsibility to dispose of that asset, okay? Now, what about our procedures to obtain audit evidence, okay? And let's start with completeness. And again, guys, just as we said for inventory, you can physically visualize yourself auditing the assertions here now, right? Okay, so for completeness, what happens? We're going to sit here and we're going to select a sample of actual fixed assets, and then we're going to, okay, looky here, they say trace actual fixed assets and find them in the subsidiary ledger. Find the printer, go see that it's in the subsidiary ledger, right? Okay, that's for completeness. For existence now, let's take a look. And they tell us that we should go from the accounting records and go and examine the asset. I'm not even going to highlight that. I mean, I think we're getting that now, right? Okay, but I do want to highlight something else that's a good exam trick, okay? The auditor should also consider selecting older fixed assets from the subsidiary ledger and locating those, looking for unrecorded retirements. Now, I think the reason we're phrasing that way is there was a CPA exam question that said the auditor is looking for unrecorded retirements. This is the exam messing with you because they're saying unrecorded. You hear the word unrecorded, you're thinking what? Completeness. But if it's an unrecorded retirement, it's existence. They got rid of something and it's still sitting on the books. So you look and you say, oh, really? You have a computer that you've had around here since 1983, huh? Let me see it, right? Because we all know that what? computers that were designed in 1983 probably don't have to work anymore, right? Okay, so you would go and you'd want to see that thing, okay? And you probably want them to write that off anyway, okay? So be careful with that one. That's why I'm having you flashcard that, because it sounds like completeness because it's using the word unrecorded, but it's actually existence if it's an unrecorded retirement, okay? Now, come back up, valuation, allocation now, the what? The mantra has been recalculate. When we have valuation allocation, we recalculate to see if we agree with what they do. Okay, that's an accounting estimate. When you deal with accounting estimates, you recalculate. Okay, you can even put in there accounting estimate. Depreciation is an estimate. Okay. Okay, good. Come down and let's take a look at rights and obligations. And of course, we're going to want to see if they purchased the thing, deeds, if we're talking about some sort of real estate, and so on. Okay, you can flashcard that. I think that's pretty obvious, but go ahead and flashcard that for rights and obligations. And then for our completeness over transactions. Okay, now we've looked at the account balances. But for transactions, we're going to look at repair and maintenance. And if they've told us that they capitalize any amounts over $10,000 need to be capitalized, then we'd look in the repair and maintenance and we see repair, it cost them $10,000. Well, why wasn't that capitalized, right? Okay, so you can flashcard that. Okay, coming over. Let's take a look at the valuation. Okay, again, depreciation should be recalculated. We've said that 52 times now. And then when we talk about understandability, and the important thing here is classification, and I've already had you flashcard that the auditor is interested in seeing if there were repairs that should have been capitalized, right? And by the way, vice versa, maybe they capitalized something that should have been expensed because it was just not that significant of a repair. Okay. Okay, good. And then when we talk about presentation and disclosure, obviously depreciation methods, useful life, are things that we should expect to see disclosed somewhere defined in the footnotes. Okay, good. Not a real hard area to visualize, and by analogy, you should be thinking about how that would relate to assertions for maybe something that's not as, physically obvious as a property, plant, and equipment. Okay, good. Let's go ahead then and let's take a look at another question. Okay, good. Looks like most of us have had a chance to try this one. So let's take a look. And okay, we got pretty good results in 80% on that, but I would have thought we would have got 100%. The correct answer is A, but we have a couple of votes for C, vote for B. So let's go ahead and let's have a little discussion here. So I'm looking for an unrecorded retirement. Okay, so that means that when I look at the subsidiary ledger, they say 1980 Apple computer. It says that. Now, do you think a company is going to keep a 1980 Apple computer other than for museum purposes?
No.
Okay, so that's probably not there anymore, yet they're saying that it's there. So you're thinking that that should not be in the subsidiary ledger. If you're thinking that that should not be in the subsidiary ledger, if you think they should have crossed that out, erased it, removed it from the subsidiary ledger, what assertion is that?
Existence.
That's the existence assertion. That thing does not exist on the company's premises anymore. So what would you do if you wanted existence? You would pick that thing, and then that's your eyes. You would go look for it, wouldn't you? By touring the client's facility?
Yes.
Okay, which is A. Now, somebody picked B, tour the facilities, and then, well, that's going to be completeness. I see the thing, and then I want to go find it in the records. That's completeness, right? Now, you might have picked B because it said unrecorded. And when you hear the unrecorded word, you're thinking we're talking about a completeness. But if it's an unrecorded retirement, it's existence. Okay. Now, I'm curious because I think a couple people picked C. And I'm trying to understand why C would tell you anything here about unrecorded retirements. So you see that they perform some repairs and maintenance, and then you're going to tour the facility to see if the thing that they're saying that they repaired and maintained is not there anymore. Someone want to help me with why C would make any sense? Okay, well, a couple of you voted for it. And then D, tour the facility and then analyze the repair and maintenance account. I don't know, you know, sometimes guys, I run out of gas and trying to explain why the wrong answer is wrong. Okay. Okay, good. Okay, come over then and let's take a look at the payroll cycle. Now, payroll is heavy. Payroll is heavy, even though we kind of buried it here in the middle. But payroll is pretty easy thing to audit. What happens? First of all, we want to make sure that there's no fake employees. Okay, so we're going to look for internal controls over fake employees, and we're going to do a couple steps to make sure that someone that is being paid really is an employee of the company, right? Okay, after we're kind of comfortable with that, then it's really a matter of, okay, does the amount of payroll make sense based on the number of employees they have and what they're saying they're paying them? Okay, that's not a big deal. Then we're probably going to have what? Some accruals with payroll, because December 31st often what comes, yet they still are not going to pay the employees because the week doesn't end until into the next year. So we'll want to recalculate, right, any accruals. And we're done. I mean, there's not a lot, you know, that has to be done. The analytical procedure, what do employees make times the number of employees in the different pay brackets, that should tie pretty closely with the amount of the payroll is, and then recalculate any year-end accruals. And we're pretty much done. Okay, so let's just go ahead and look though, starting with the internal controls that are basically trying to make sure that, you know, we don't have any fake employees. Or somebody, you know, hires their brother-in-law and pays them some high salary or something, right? That's why we want what? That's why we want segregation of duties between what? Between the ability to hire new employees and then actually maintaining the personnel records and, you know, actually paying the person. Okay. So the human resources department is the one that will have the employment records and stuff. Okay. So that's obviously what? Authorization. Then what? The supervisor is authorized to do what? To direct the effort. Sometimes people say, well, you know, authorization, supervision is custody. That's a little crude. They are authorized to direct the efforts of the employee. Timekeeping and cost accounting is what? Is obviously record keeping, as is the payroll check preparation is obviously a record keeping step. Okay. When we get to the distribution of checks of the actual pay, that's custody. Okay. Now we're going to see in a couple of instances, they talk about observing the check distribution as though it is what? 1969. Okay. Almost everybody is what? On direct deposit. So what we're going to really focus in is what? How do you make sure that it has been deposited directly into the correct account? And we'll take a little bit of a look at that. Okay. Now we come over and we say that the internal auditing department should periodically compare personnel files with payroll files to help ensure that only authorized payments to appropriate personnel have been made. So again, all about what? Internal control. That's an internal control because we're saying the internal auditing department, that makes this an internal control of the entity, should periodically make sure that someone's getting paid, they were really hired. Okay. So how will we do the internal control evaluation? And we're going to see that it's all about making sure we don't have fake employees. Okay. So observe the segregation of duties between human resources and responsibility to do payroll distribution. Compare personnel records with actual time cards. Okay. Observe payroll distribution on an unannounced basis. Again, flashcard that. The exam still acts like it is 1968. Okay. Almost everybody's on direct deposit. Now, I did have a friend, I guess this was maybe about the middle 2000s. You know, she says, well, hey, you want to go to lunch? Let's go to lunch. Okay, go to lunch. He said, oh, I got to stop at the bank because I have to deposit my paycheck. I'm like, what? What year is this? Let's take a horse and buggy to the bank then to do that. Okay, but sometimes you see that, but for the most part, everyone's on direct deposit. Okay, observe the use of time clocks. Okay, if there's time cards that are not used, how come? Test transfers and underlying employee authorization. There we go. Let's move into the 90s over here, right? Okay. So what happens? Most companies use direct deposit. So what happens? The employee will have to authorize that, right? And they're going to put their account number and they're going to sign that. Well, you can take that direct deposit authorization and you can go ahead and do what? You can compare that to, say, their W-4 that they would have also signed when they came in to authorize the withholdings and whatnot. So now you got a match for match on the signature. And then, since it's saying deposit and bank account number 1, 2 would be, you know, the 12th Federal Reserve District, whatever the rest of the account number is, the routing number on there. Well, then you could look to see that the client is showing that they got an acknowledgement back from the bank, because when they make that direct deposit, the bank will acknowledge you deposited money in this account number. And you can see, okay, the employee authorized direct deposit, and indeed there was a payroll distribution that went to that account number as authorized by that employee. Okay. You also would want to go ahead and test general and applications for, and then general and application controls for payroll. Okay. And, you know, general controls over that would make sure there's appropriate password use. And then application controls might be some sort of limit on the payroll. So what happens? Because payroll checks are so widely dispersed, you probably would want your client to run their payroll through an impressed fund. that has what? Not their general accounts, but an impress fund means that only payroll runs through that bank account, so that what, you can't wipe out the company by making up some sort of fake payroll distribution or something. The other thing you'd probably want to do is see that there's only a limit as to what any one single transaction should be. There shouldn't be a single transaction that wipes out the entire payroll account, because that's distributed amongst several employees, right? So these would be application controls that you'd be looking for over payroll transactions. Okay. Okay, good. So you'd have sort of predetermined maximum and minimums, a range of tests, impressed account, that sort of thing. Okay. Okay, good. Now we come over and let's take a look at auditing the payroll accrual. Okay, and that is something that is going to be done. Okay, when control over payroll is effective, our generally focuses on substantive procedures, substantive analytical procedures, and recalculation of payroll accrual. I mean, that's the big thing. Once you're satisfied that there's not fake employees and they've got those controls that we set up there, you're going to go ahead and do some tests that are going to really focus on the accruals. Now, if you feel that, and do an analytical procedure, if you feel that there are some problems, then you may want to do some of these existence and completeness tests. So let's go ahead and look at the existence completeness test, and let's flashcard those, but understanding that we're doing those when we think controls are weak. So for completeness, you're going to do what? You're going to look at the time card data and see that what? See that that was properly recorded. So you'll start with the time cards, right? Okay. If we're talking about existence, then you'll start with the payroll register, and then you'll look to see that there's some time cards that support that, right? Okay. And then you will do what? You will recalculate any year-end accruals, flashcard that, and then you will probably just do an analytical procedure, as I've already mentioned up there. That analytical procedure really would be what? How many employees do you have? What are the pay rates at different categories? And see if that turns out, right? So I have 100 employees that are about this pay category, multiply that, higher pay categories, multiply that, make a comparison to what their recording is, their payroll expense for the period, whatever, and you're pretty much done. Okay. Okay, good. So let's just go ahead and take a look. And that's what they're talking about here. Compare payroll with standard budgets. That's an analytical procedure, so you can flashcard that. I mean, you don't accidentally hire a bunch of employees, right? So it should pretty much tie to what was predicted in the budget. That's an analytical procedure. Okay, good. So pretty easy. Make sure there's no fake employees. Okay. Then what? Look for the internal controls over that. Then what? Recalculate any year-end accruals. Sit there and make sure that their, payroll seems reasonable based on an analytical procedure comparing to budget. If you have problems with the controls, then yeah, you might want to start doing some of those completeness tests, for example, by going from the clock data to the payroll register, for the payroll register, the clock data. But that's typically done if there's some issues with the controls. Okay, good. Let's go ahead then. Let's take a look at this question. Okay, guys, looks like it's a little bit quick, but it looks like most of us have tried this one. So I'm going to go ahead and end the poll. And yeah, pretty good results. 92% of us got this correct. And that we're really, if we want to make sure that the, we're going from a sample of employees in the payroll register, which constitutes the accounting records, to the supporting document, the time cards. We're talking about the existence occurrence assertion. They actually work the hours that they put down. Okay. Now, when I look at choice A, which a couple of us picked, there are no rates that are shown on the time card. I mean, that would only give you the amount of hours they work. So I don't see how that would help you with rates. Okay. Rates, maybe you're looking at some sort of, initial human resource document that shows what the person's going to get paid annually or something, or maybe it's in hourly, it says in there, whatever. Okay. Okay, good. Let's go ahead and let's take a look at the financing cycle. Financing cycle is light. Okay, now we talk about financing, we'll talk about debt financing, we'll talk about equity financing, and they kind of weave back and forth between the two here, guys, as we go through. So we'll try to make sure that I'm making clear which one they're talking about as we go through. Okay, so first, internal controls related to debt. Okay, that's they're issuing bonds to get financing, and it's got to be authorized high levels. Okay, you don't let supervisors decide if you're going to indebt the company. That's coming from the board of directors or senior management, right? Okay, now you come over and we're talking about equity, issuance of stock. Okay, that comes that has to be authorized at high levels of the organization. So you're looking for something from the board of directors. Okay, now you come over and sometimes once the issuance of stock is authorized, entities could use a stock transfer agent, and they maintain the number of shares authorized, issued, and outstanding. And that's important because we do disclose that on the balance sheet, don't we? The number of shares authorized, issued, and outstanding. Okay. So you would want to see if a stock transfer agent is used, if they have that information. If a stock transfer agent is not used, then we start doing that internally into the company. Let's flashcard what we do when I probably could have wrote the flashcard up there. When the stock transfer agent is not used, let's flashcard what we're supposed to do. An officer of the entity should be responsible for ensuring that stocks transactions comply with the articles of corporation. They maintain the stock certificate book, and whoever maintains that stock certificate book should have no accounting responsibility. Okay. Okay, good. And then they say that there should be independent reconciliation of stock certificate book. And when they say independent, they mean independent of what the stock officer that's responsible for this is doing. So I think they're talking about what? Independent, they're talking about internal auditor. Okay, don't get confused with the idea of the true independent person. We're not talking about the external auditor doing that. Okay, now if we're talking about debt, okay, and we're now going to go ahead and perform some substantive procedures, right? And if we're talking about debt, let's take a look at the debt. And all new debt contracts should go to the financial statements. Okay, I'm going to go ahead and highlight the word trace, although you know that I don't like that, okay, because I don't want you to memorize the word trace, but that should go new debt contract. See that there is recorded as debt in the financial statements for completeness. And then any debt disclosed on the standard bank confirmation should be taken back to the financial statements. Flashcard that. We talked about that bank confirmation. And if they check, yes, there is a debt here, then it should be listed as a completeness test, right? Okay. Come over and for valuation allocation, what is the mantra? Recalculate. Okay, so basically, we're going to sit there and recalculate. And the way we would recalculate, okay, just to kind of, get comfortable, we basically sit there and we say, well, the debt balance is X, $1 million. And then we might say, well, the average interest rate for the outstanding debt of the company, and we calculate that at, say, 4%. So now we should be able to sit there and say, well, interest expense ought to be about what? Here I go again, giving myself numbers and I can't figure them out. 40,000.
40,000.
Okay, so interest expense ought to be 40,000. Now, if we look at the interest expense and it's 90,000, well, maybe there's some debt that they haven't reported correctly or something, right? Okay, so you'd want to start to investigate that. So that's basically an analytical procedure, and they say the auditor should recompute, but that's really recalculation, which is basically what we've been saying all night long now for a couple of class sessions now about the valuation allocation assertion. Okay. Now you come over and you take a look at the next page, and for the completeness, okay, the auditor should review interest expense for payments to debt holders not included in the debt listing. So you see something that is put in the, disbursements ledger, and it has some sort of code or something that indicates it's for interest expense, and you see the name of the entity that's being paid that interest, and then you look and there's no debt for that person. How come? Okay, did we, did the company forget to sit there, and I do the quotes because maybe they did it intentionally, list the actual debt associated with that interest payment, right? Okay, good. Come over, and when we get into our presentation and disclosure things, if there are some sort of restrictive loan covenants, we will absolutely, in fact, I haven't asked you to flashcard much presentation and disclosure issues, but this is a big one. Because if there is something that says if the debt to equity ratio falls out of a certain tolerance, then there's going to be a requirement that they pay on that debt immediately. And that might be a covenant that's put in there to protect the bondholders from the company over leveraging themselves to the disadvantage of existing bondholders. And sometimes bondholders will say, hey, if we're going to lend you money or debtor creditors, I should say, if we're going to lend you money at this interest rate, then you can't issue any more debt or something. And we want to make sure that that is being properly disclosed. Okay. Okay, good. And then if we're talking about, that's our debt. If we're talking about equity now, okay, now we're talking about stock. Okay, so for completeness, if the client uses a stock transfer agent, ask the stock transfer agent to give you the information that you need to, again, make sure that they properly put on the balance sheet the numbers to shares authorized, issued, and outstanding. Okay. The other thing, just coming down, because we're talking about stockholders' equity here, if there are some sort of restrictions on retained earnings, or retained earnings are appropriated somehow, then we would want that to be properly classified. We would have to debit the unappropriated retained earnings and credit appropriated retained earnings to show that there is some restriction on that. Okay. Okay, good. Again, financing cycle fairly light, but let's go ahead and let's take a look at a multiple choice question for that. Okay, looks like most of us have had a chance and we're coming up on 2 minutes. So I'm going to go ahead and end the poll. And okay, pretty good results, 86%. That's pretty good. The correct answer here is C. Okay, but let's just take a look at this one. And they tell us that in auditing long-term bond payable, the auditor most likely would do what? And some of us picked A, perform analytical procedure on bond premium and discount accounts, okay? That's probably not an analytical procedure. That's probably a recalculation. I will go and see that they properly amortize the premium discounts, okay? B, examine documents of assets purchased with bond proceeds for liens. And I'm looking at that and I'm thinking, well, that might be a good step for what? For the rights over assets. That doesn't help me with bond payable, okay? Compare interest expense with bond payable amount for reasonableness. Okay, there should be a what? Correlation there. What did you pay in interest? What did you have as outstanding bonds? I can audit those related accounts simultaneously, and one sort of feeds off the other, right? Okay, and so that would probably be something that I absolutely would do. D, confirm the existence of individual bondholders. Okay, confirmation is probably not the key thing that we would most likely do for bond payable. You may do this, and you could confirm, and you'd probably use what? Blank positive confirmation if you did this, but it's not the most likely step. Getting comfortable with interest expense and bond payable, yeah. Okay. And that, by the way, is an analytical procedure. So you probably wouldn't use analytical procedure for premium and discounts. You'd recalculate. C is describing an analytical procedure, isn't it? Okay. Okay, good. Let's take a look at our next section. Okay, but before we get to that, let me pause. We went through the account cycles, right? 30 points, guys. 30 points. You've got to get comfortable with that stuff from module 1 all the way through module 6. If you don't spend the requisite time getting comfortable with how to audit those assertions, you will be up a shit creek. Let me put it that way. Let me just be frank. Day of exam. You've got to get that part down. Okay, that is key. That is central. Okay. All right, good. Now we talk about matters that require, I don't know, special consideration. That's a little vague. Okay, so let's just deal with these one section at a time, starting with litigation, claim, and assessment. Okay, so what happened? If there is a belief that the client is going to fall under some sort of litigation, that needs to be what? Properly disclosed. If it is what? Probable and estimable that the client is going to suffer some sort of loss. We're looking for loss contingency there. We will literally debit loss and credit a liability either for whatever we think the amount's going to be, or we will do what? We'll look at a range and we'll take the lower end of that range to book that. If we think it is what? Reasonably possible, then we'll have to disclose the range of losses, all those accounting rules, right? So the auditor got to get comfortable that that's being done properly. Okay, so what happens? We are going to be looking, and we're going to be looking for the period in which the underlying case for legal action has occurred. the degree of, and guys, we're looking for bad stuff, unfavorable outcome, potential loss. If we think they're going to win a case, we don't book a contingent gain. It's always what the loss side that we're looking for. Okay. Now, how will we identify potential litigation? Okay. And let's just go ahead and flashcard how we're going to identify this. Okay. And we'll ask management, hey, any litigation going on that you got to, book some sort of loss for? If we see that the IRS is writing them letters, I mean, something like the State Franchise Tax Board sent me for no apparent reason. Okay, if there's something like that coming around, then you want to investigate that. Maybe they have to book some sort of loss, right? Review stockholders meetings, and not only review them for during the year, but maybe early into that next year, because maybe that's something that's happened and they don't get around to talking to it until later on. Okay. And then obtain letter from the client's attorney, and that's going to be really talked about here coming up on the next page. Okay, and here we go. 2.1, we call that the client attorney letter. Okay, so let's just go, or not 2.1, but 1.1. There used to be a section in there that they got rid of. So now that's now not 2.1, John, but 1.1. But it is, and it's not on the next page either. It's right here now. Used to be on the next page. Okay, but it's right here. Okay, that's what they're talking about. All right, so let's go ahead and let's take a look at what happens. Okay, and so when those procedures that are up there in green indicate that there are litigations, claims, and assessment, the auditor should get direct communication with the entity's external legal counsel or with the internal counsel if they don't have external counsel. Okay. Now, this letter is prepared by management and sent by the auditor to the attorney. So it's written in management's voice, but then the letter goes directly to the client's attorney. Okay. Now, just coming down a little bit over to the next page. Okay, let's just come down to the next page. The attorney, in turn, sends the letter directly back to the auditor. Okay, and in the reply, the attorney give their evaluation concerning litigation, claim, and assessment, and what is the possibility that there will be an unfavorable outcome. Okay. Now, you come over and we mention here that if it is in-house legal counsel, then you would go ahead and you would ask to speak to the in-house counsel. Otherwise, you send the letter to the external counsel, and then the external counsel does what? They send the letter straight back to the attorney. The attorney sends the letter straight back to the auditor. Okay, so the auditor controls and sends the letter to the attorney responds directly to the auditor. Okay, now, what happens if the client says to you, no, you ain't talking to my attorney? Are you comfortable?
No.
No, okay, you're not too comfortable. So what happens? The client's refusal to permit inquiry is going to result in what? Disclaimer or withdraw from the audit. Okay, you got to let them talk to you. You got to let them. You got to talk to the attorney. Okay, and get that letter back. Okay, now come over, and if you decide for some reason not to have direct communication with that auditor, you better, with that attorney, you better do what? You better document the hell out of that reason. Why? Okay, and it can't be, well, because the client told me they didn't want me to. No, that's not sufficient reason. Okay, now, when the attorney sends the letter back to the auditor, and there was agreement between the bar associations and the AICPA as to how that letter would be handled. Okay, and in there, they negotiated that the attorney could limit their responses to matters that they had given substantial attention to. Okay, so what happens? You know, if your attorney sends you an email to wish you happy birthday, don't respond, because they will charge you for the responding to your response. Okay, so don't respond to it. Okay, so you know, attorneys might have some limited contact with you, even though they may bill you for that. That's not the kind of thing we're looking for in this. It's to matters to where they've started taking deposition and this kind of thing. Okay, now there's also a confidentiality limitation. Okay, and the attorneys reserve the right not to put in the letter things that, if disclosed in the financial statements, would bring the lawsuit. So there's been substantial attention dedicated to the potential that we violated a patent, for example. You disclose that in the financial statements. Now you're doing what? You're potentially bringing the lawsuit if somebody thinks that you violated their patent. So the attorney is allowed to leave certain things out. Okay. So this client attorney letter, in my opinion, is not the greatest evidence ever, because they could decide under client attorney privilege to leave some things out, right? So the real thing is management being upfront with you. Really, that thing in the management representation letter where they tell you they have disclosed to you litigation claim and assessment is, to me, the more reliable evidence here. But they do want us to do that. Now, if the attorney won't respond, then that is a sufficient scope limitation to preclude unmodified opinion. So we're talking about what? We're talking about qualified or what? If it's a scope limitation, we're talking qualified or claim, and you may even decide to withdraw, right? Okay. Okay, good. Inherent uncertainties. Let's take a look. In some cases, inherent uncertainties may make it difficult for the attorney to form a conclusion. If the auditor is satisfied that the financial statements disclose that, no modification is required. Look, we can't sit there and beat the attorney and say, give us a number. Tell us how much the loss is going to be. Well, you know, the attorney may say, okay, I think there may be an unfavorable outcome. I don't know the amount. As long as there's proper what? Disclosure, and we would expect probably a range of the losses, but even then, maybe they can't come up with a range. As long as that situation is fully disclosed, then we don't have to modify our opinion, because we're sitting there and saying, well, you know, that's the accounting standards. Accounting standards say you're supposed to put something in there if you can, but they don't want you just pulling things out of the air and putting them in there either. So as long as you disclose that, you're okay. Okay, good. Let's take a look at what happens just coming down. What happens when? Oh, okay. Sorry, there's a question there. Let's look at that question. I find this question a little bit, this question's a little bit amusing to me, entertaining in an amusing way, but let's go ahead and let's take a look at this one. Okay, guys, looks like most of us have had a chance to try this one. And okay, I think I'm somewhat satisfied with the results here because I can see why some folks would have picked D. But let's go ahead and let's take a look at this question regarding the client attorney letter. In which of the following audit procedure the auditor most likely, well, it's not really specific to client attorney letter, it's performed concerning litigation claim and assessment. And so I'm going to read A and B, even though nobody picked them because they're kind of funny. Request the client's lawyer to evaluate whether the client's pending litigation indicated going concern problem. Well, that's an accountant's job. Accountants do that. And we're going to see that section here in a minute. B, examine legal documents in the client's lawyer's possession. Yeah, try it sometime. Go to the client's attorney and say, let me see your work product. The attorney's going to say, yeah, right. Okay. C, discuss with management's controls adopted for evaluating litigation claim assessment. Yeah, remember we said discuss with management. How do you do this? Okay. D, confirm directly with the client's lawyer. Well, we do have direct communication with the client's lawyer, but it's what? Getting their opinion about litigation claim and assessment and what the degree is an unfavorable outcome. We don't look at them and say, hey, are all litigation claims and assessment properly recorded in the financial statements? I mean, the attorney's going to say, so what do you want me to do? Come over there and do your work for you? That's our job. That's not the job. They will send a letter to us discussing the degree of an unfavorable outcome. It becomes our job then to make sure it's probably disclosed and recorded in the financial statements. Okay. Okay, good. So D, you know, if you picked it, I think you got pulled in by the what? Direct confirm, you know, directly. That phrase pulled you in. Okay, good. Now, as we've mentioned just a second ago, it is the job of the entity to determine if the entity has the ability to continue as a going concern. And if they do not, they need to properly disclose that. But it's also the auditor's job to take a look at that. And then if they identify a situation, they want that properly disclosed, right? Okay. So you take a look and they tell us that on every audit, the auditor is responsible for evaluating whether there's substantial doubt about an entity's ability to continue as a going concern. Okay. And we say for a reasonable period of time, and pretty much, guys, let's not get too far off into GASB versus FASB. 1 year after the date, okay, what happens? We don't want somebody sitting there saying, well, you know, if you're looking at an oil company and you're looking at the fact that we're putting in chargers across the country and electric vehicles are becoming more and more prominent. So in 50 years, this oil company is going to be out of business. So let's put a going concern. No, okay, that's not what we're looking for. We're looking for what? A reasonable period of time, which is pretty much defined as 1 year. Okay. Now, how will the auditor determine if there are conditions that indicate that the entity may have substantial doubt about their ability to continue and going concern? Okay. And so we have the mnemonic here, fines. Okay. So let's just take a look at some of the indicators. Fines, F-I-N-E, or fine, I guess not fines, but fine. Okay. Financial difficulties. Losses period after period. I mean, a big one, guys, is if you look at cash flows provided by operating activities, and that's a negative number, and that keeps happening, you can calculate a burn rate as to when they're going to be out of cash, can't you? Okay, so that might raise a going concern. Internal matters, maybe, you know, a couple partners can't get along. Negative trends, again, losses period after period. External matters, legal proceedings, etc. Okay, so flashcard, the factors that may indicate a substantial doubt about an entity's ability to continue as a going concern. Okay, now just because you see these problems doesn't mean that the entity has a going concern issue. you will need to look for potential mitigating factors, things that will make you say, okay, they're going to be okay. For example, maybe they can borrow money or restructure debt. Maybe they can sell some assets, delay or reduce expenditures, increase ownership equity. Now, when you look at these things, is the company that's experiencing all these financial hardships and whatnot going to be able to raise stock, sell equity? Probably not, right? So it's not good enough for them to say, well, this is what we're going to do. They also have to have what? The ability to carry out the mitigating factors, okay? So you look at this and you look at some of these things, and I was on the audit of the consolidated financial statements of the federal government, and somebody got this smart idea that we should look to see if the federal government had a going concern problem. And somehow I was not moving fast enough. I got sucked into that assignment. And I kept saying, guys, what are you talking about? You're talking about an entity that can borrow at the risk-free rate of return at any point in time. You're talking about an entity that can raise revenue at will. It's called tax. I mean, what are we doing? Please get me off of this assignment, somebody. And that's one of the few times that because people were actually going through analysis on this. I'm like, this is stupid. I don't want to do this assignment. So that was one of the few times in my entire career that I begged to get off an assignment. I finally did because it was ridiculous. And then eventually the whole assignment, the plug got pulled on it. This is not necessary. Okay. So what happens? You sit there and you need to look at that, and then you need to look at potential mitigating factors, which in my mind, the federal government had the biggest mitigating factor of all is if we're really going to lose it, we'll go ahead and we'll just bomb somebody and take their stuff, right? Okay, so anyway, you would look for mitigating factors. Now, you go ahead and after looking at these mitigating factors, you determine that you don't have the going concern anymore, then you can stop there and you don't have to sit there and continue to worry about it. And then if you had the concern in the later periods, whatever caused your concern are removed as time passes, then the auditor does not have to continue to put something about the problem with the going concern. Okay, good. When you look at the mitigating factors, if you're satisfied, but that doesn't mean that you still wouldn't want some sort of disclosure about the kinds of things you saw that originally gave you your concern. Now, if you see some sort of problem, okay, then you are going to have to issue a report, okay, and in your report, you will add a separate paragraph in the report with the heading substantial doubt about the entity's ability to continue as a going concern. So flashcard that. You will actually modify the report for that, okay? And the report modification has to have the words substantial doubt and going concern. Those words have to be in there, okay? So you're basically expecting that that's something that is worthy of the audit report. Okay, and you put that in there. If we're talking about issuers, then it's going to be what? An explanatory paragraph that, again, in both cases, has to have the word substantial doubt and going concern. Okay. Now, note that they tell us that the auditor is not precluded from issuing a disclaimer of opinion because they really don't know how significant this issue related to the going concern is. Okay, all right, documentation requirements, and let's go ahead and flashcard these because it's a nice summary of the area, and I want you to remember what needs to be documented. So what were the conditions, the fine issues that gave rise to the substantial doubt concern, the going concern, any mitigating factors? What did the auditor do to evaluate management's ability to mitigate the substantial doubt? The auditor's conclusion about whether the substantial doubt now has been alleviated, and then how did it affect the auditor's report? Did we have to add the paragraph with the going concern, or it was alleviated, but we look for some disclosures on that, et cetera. Okay. Now, if the going concern disclosures are inadequate, wait for it, look at me. What do we do if disclosures are not adequate?
Disclaim.
No, if disclosures are not adequate, they didn't follow GAAP, qualified or adverse, right? Okay, good. If we're sitting there and the auditor doubts, where am I here? The auditor's doubts about the entity's ability to continue as a going concern are removed in a prior period, then we don't have to continue that. So let's say we're showing 2022 statements and 2023 comparative statements, and we had a concern in 2022. By 2023, they've righted the ship. We don't have to put the going concern paragraph in there again. Okay, we just put it in when it's existing under the current year under audit. Okay. Okay, good. So let's go ahead and let's take a look at this question. Assuming I can find the poll here. Okay, guys, looks like all of us have had a chance to try this one and everybody got it right. You have to have the words what? Substantial doubt and going concern, not reasonable period of time. We need to consider a reasonable period of time and it really shouldn't exceed 1 year, but those words are not required words. It's substantial doubt and going concern. Good. Okay, with the little bit of time we have left, I think it's worth the investment here to go ahead and try to get through the accounting estimate, even if we go a little over time, because that will complete the module. And so we can go ahead and be comfortable working through all the questions in this module. So hang tight for a second, guys. So we've got a little bit left to go. Okay, so we talk about accounting estimates here. And of course, all night long, I won't sing to you, okay? All night long, what? The word associated with accounting estimates has been what? Recalculate, okay? All night and last time as well, okay? So let's just go ahead and let's take a look. And the auditor's responsibility is to what? To make sure that the proper estimates have been made. Okay, so let's just take a look. Okay, we want to make sure that they have developed appropriate estimates. Okay, so how are we going to do that? Audit procedures. Okay, and we're basically going to evaluate and obtain an understanding of how management developed the estimate. Flashcard that. How did management develop that estimate? That's something that we are interested in. Okay, and then keep coming down and flashcard the ones I highlight here, guys. Develop an independent estimate for comparative purposes. In other words, do what? Recalculate. Okay, and then evaluate subsequent events through the what? Through the subsequent period occurring up to the auditors, the date of the auditor's report. That's that other question we had before. After the date of the auditor's report, you don't need to worry. Okay. Okay, good. All right. Let's go ahead and let's end right there. Okay, so actually, I thought we were going to get out later when we got a little earlier. So we're going to stop there, guys. We obviously can't finish module 8 in the time we have left. And I think you've got a pretty good chunk of work cut out for you now, which is finishing up anything that's done and getting through a good chunk of module 4. Next time, we'll pick up here with module 8. And then I had already planned to push the module 9 into next time as we start talking about dealing with internal control deficiencies, because that really feeds into what we do in the next chapter, where we start really digging into what happens with the internal control communication. Okay. Question? All right, guys, make sure you're getting through the homework. I am going to be peeking at that. I will post the recording for the guest speaker, but you do not have to turn in the guest speaker. Okay, I'd much rather you spend that time catching up on homeworks and stuff. And since we're falling a little behind, I want to make sure that you're focusing on the prize here, which is getting through the material to be able to take your exam and do well on it. Okay. Okay, guys.
Thank you.
See you soon.
Thank you.
Have a
Thank
good
you.
night.
Have a good
Thank
night.
you.
Good night.
Thank you. Good night.
Good night.